Welcome everyone. How we doing? Welcome everyone. How we doing? Hope everybody had an enjoyable day off. Wiz, how we doing? Saw Lambo's name pop up real early. He might have been number one. That's the facts, Lambos. Perfect attendance. Welcome everyone. Give it a few more minutes. I always like to give 5 or so minutes for people to show up, but how's everybody doing? Nice little day off today. Hope everybody got to enjoy it. Spy trying to play catch up to the US move down. I didn't know what time it was going to open today. Is Tesla. I sure have seen that one happen. Ooh. Tesla did funny things off the open. 390 to 400 on the opening candle. It's funny. Is it the gap and bounce? I'm sure market makers and everybody, I'm sure their computers are a bit confused of like, why were we closed and now we're open? Welcome everybody. We'll just give it a few more minutes. How's everybody doing? Thanks for joining me on this Thursday night. Hey, thank you. You too. You too. Happy 2025. Market's been a wild one so far this year. Trying to get a couple things ready and we'll get rolling here in just a minute. And oops, one more second, we will be rolling. Welcome everybody. Just gonna make another post real quick. Okay, and welcome everybody. Happy to have you here, Dirty River. Tonight we are doing class number 7 in my series. I think we only got a couple more classes left. I don't actually remember, probably only one or two more after this. We've been covering, all kinds of technical stuff, really working our ways, understanding charts, understanding how to look at them in the big picture, EMAs to use, charting support, resistance, and trends, actually trading around those, trading in trends, trading in range days, all of that good stuff. And now we're going to talk about something that I think a lot of people struggle with. And it's contract selection is the talk tonight. And so contract selection is tricky because it's one of those things where you can't you can't just have this specific set of rules where it is always correct. The thing about options trading is, there is a time and a place for almost everything. So you can't, and well, just as a random example, you can't say something like, I will never trade a contract with less than 30 delta. And we'll get into a little bit more what that means soon. You you can't just make a statement like that because there might be times where trading that 10 delta contract is the very obvious answer to do, you know? So you can't just have this one idea. I only follow these very specific rules for contract selection. You really need to base it on the type of trade that you're taking, your plan for the trade, all of that. And so we're going to do, I should look it up real quick just so I can see the schedule to make sure it's gonna, go in the right ordered. But so we're doing contract selection tonight. We've done trends, we've done ranges. Tonight we're doing contract selection. Next week we're doing price action, which is, you know, eh, with I don't know how else to describe it, but it's trading what the chart tells you to do. You know, where it's kind of going to be us putting some of the things together and actually looking at the chart and thinking about some trades because of it. And then the final one, well, we're going to have a Q&A after, but the actual like, teaching classes from my series, the final one we're going to do is building a trade plan, obviously with all of the stuff that we've learned from all of these classes. But tonight we're going to be talking contract selection. It's of course part of all trade plans. It should be part of all trade plans. And it just gives you a lot of control of, your potential loss, your potential gain. As all of you guys know, I always try to preach to just, you need to know the risks that the trade you are entering involve before you take that trade. And really you're unable to do that without at least looking a little bit into the contracts that you're choosing. And so tonight we're going to go over, the first 5 or 10 minutes. I'm going to do it kind of, well, somewhat quick. Obviously, if you have questions, please ask them as we're going, but we're going to cover options Greeks first. We aren't going to get into some deep dive of how they're calculated or anything like that. Really, all we're going to do is talk about, how they affect the contracts and why we might choose different contracts for different scenarios. We're going to talk about, some big money ideas as well, because, it goes into, I don't use it. A lot of people like to look at flow. And so there's always this really common question that comes from flow. That why is somebody taking this trade? And so tonight I just want to talk a little bit about that, just because it's a question we get asked a lot. But we'll get into that later. Like I said, contract selection. We're going to cover scalping. We're going to cover day trading. We're going to cover swing trading. The things that I personally like to look for when I'm taking contracts in each of those different situations. And so, I got to get the chat open again. Oh, I see a question. What time are my other six classes under? They should be all down, very bottom, lower left, latest lectures. They should all be in there. They should all also be in order in there. But then I also have the last time I did this series here about, I don't know, 6 months or so ago, a buddy of mine put together a YouTube just playlist for it. So it's easy to access. And I'm going to try to ask real nice and see if he'll do it again for this series. And so hopefully I'll be able to just post that link to all of them together once it's all wrapped up. And so with that, let's get into it. So first thing we're going to talk is, like I said, option Greeks, option chain, things that we can look for on this. We're actually kind of in this unfortunate situation today where, because the market had the unplanned closure today, a lot of the option prices look all messed up. So it's kind of unfortunate that we're talking options and options Greeks today, just because so many of the numbers are all messed up due to an unexpectedly closed day that spiked IV, that spiked all these things, But so when I'm looking for an option, when I'm looking to enter a trade, what I always personally do, and what I think everybody should do, I mean, at least if you're on Thinkorswim, I can't actually say if you can do something like this on Webull, but I do this. I pull up the option chain, and that's what we're looking at. Let me make sure. Okay, I'm on my small account, so I don't care if anybody sees anything. This is the option chain. And what is the option chain? What are the things that we see on here? And this is how it looks on Thinkorswim. Again, it'll pretty much look the same on every broker with some minor variations. Generally speaking, the left side is going to be calls. Generally speaking, the right side is going to be puts. The strike price is going to be, when you're in voice chat or when you're in tabs or anything like that, and you hear somebody saying, 588 calls. What we mean by that is the 588, that's the strike, and we mean calls on this side. Obviously, expiration date is, going to be whatever day you're buying for expirations. And so then the next thing that I look for personally is always Greeks. And why do I look for Greeks and what do they tell me and what do they even mean? And so tonight we're only going to cover, well, we're technically going to cover 5 things. Technically speaking, only 4 of them are Greeks. So, but one of them goes the one that's not a Greek goes hand in hand with one of the Greeks. And so when you hear people discussing options, Greeks, and why you might take certain trades and things to look for when you're picking those trades, these are going to be the main Greeks that they talk about. Delta, gamma, theta. Well, let's be real here. The main Greeks that anybody is going to talk about are delta and theta. We're going to go a little bit deeper tonight. Shouldn't take long just to explain 2 of the other ones that, in my opinion, are at the very least worth noting. They won't necessarily help you pick contracts better, but they can give you a little bit more of an idea of how much money you stand to make or lose. And so the very first one we're going to talk about is delta. And so what does delta tell us? Delta tells us for every $1 that the stock moves. That's the important thing to figure out with options contracts and option selection, is that the options do not move the price of the stock. Of course, there's situations where maybe a gigantic order comes in and the market actually reacts to that order, so the price of the stock moves. But generally speaking, an option moves based on the movement of the stock. So when we're going to pick a contract and we see the delta number, we're just going to pick this first one right here, these 587 calls, 49 delta. That means, and we're going to get into a little bit more detail, but generally speaking, if the stock goes up $1, I am making $49. If the stock goes down $1, I am losing $49. That's what delta tells us. So, just real quick, how can we apply that to a chart? If, say we're trying to catch this bounce and I buy calls right here and, right here, we're going to say right here, because it's 586, just to make our math easy. I buy calls at 586 right here on the bounce. I know that my stop is down here at, and we're going to, again, do a little bit easier math, 585 new lows. So it's $1 below us. Now we know before we've taken this trade, we have $1 risk. So we are going to make or lose. You can see it's actually the deltas even, they change all day. We're going to get into that. You're going to make or lose $50 on this move. If this goes down $1, you are losing $50 on that contract. Well, on the other side, say that your target is up here, and we're just going to say VWAP, targets don't matter right now for this example. Well, we're entering at 586. We know that we're targeting, well, we're going to say 588 for easy math. So we're risking $1. That's $1 move down, that's a $50 loss. To get a $2 move up, that's a $100 gain. We now know that before we enter the trade. So I think that is, if you're going to look at any Greek, if you're going to put any effort into learning options Greeks, at the very least have delta pulled up, because it's a very easy one to look at and say, hey, I'm going to make or lose this much money. That is what you need to know before you enter any trade, at least in my opinion. So any questions on that? Does everybody understand what I mean by that? But, options move based on stock movement. Stocks don't move based on options movement. You'll hear people all the time trying to say, oh, all these people trading their contracts affecting the price. If somebody says that, don't ever listen to them again. They don't know what they're talking about. Stock moves the option price, and how much it moves is based on delta. Everybody get that? I'm seeing no comments, so we're going to say everybody gets that. Okay. Yep, and the delta is every $1. Exactly. So every $1 that it goes up, you're gonna make 50. Oh, what's up, 50 pack? So every $1 that it goes up, you are gonna make $50. If it if it goes against you, you're gonna lose $50. Well, here is, and again, this is getting into more of the advanced side of it. The next Greek we're going to talk is gamma. And what is gamma? And again, this is one of those ones that I won't, it's generally speaking not going to change the decisions you make on your contract selection. As you can see, the number here is pretty universal. And so, this one doesn't tell you a lot. Well, it tells you an important fact, a fact that I like to know, because with gamma, and I'm going to add a few more strikes just so we can see, you should never have 100 strikes pulled up. It's just a waste. But as you can see, so gamma is at its highest when you are right around the money, when you're at the money. That's where you're going to be receiving the most gamma. And we're going to get into what gamma is in a second. You can see the deeper in the money you get, the lower gamma gets. The further out the money you get, the lower gamma gets. And so what does gamma do? Super simple. It tells you how much will your delta change if the stock moves $1. So same thing, and we actually just so happened, and I'm going to get rid of some of these strikes just so it's easier again. Same thing, and we actually have a really awesome example of it on the chart right now. So gamma tells us for every $1 the stock moves, how much is the delta on our contract going to increase? So we look right here. $4 is how much the delta is going to increase if the stock moves $1. So as no surprise to anybody, if we go one strike in the money, the delta is $4 higher because it has moved that dollar already. So this is something I teach all the time. It's known as gamma exposure. It is the single-handed most powerful tool we have as options traders. It's also the reason that you do not want to be trading way out of the money contracts. Of course, the percent will be big, but your dollar amount will be small, and you won't be making money. More often than not, you'll be losing money trying to catch those kind of moves. But so what we see right here in these, few strikes right around the money is the most powerful thing in option trading. So we're just going to use the strikes that are on here as a quick example. So what I always like to tell people is this change, when you go from out of the money to in the money, is when you really start making money. So you can see, say we buy this 588 call, it has 46 delta. So without getting too detailed, basically what that represents is 46 shares of the stock. You're getting a similar movement to 46 shares. And so the move, I see a question. Can I put in first grade terms? How do you know in the money, at the money, out of the money? So in the money means, and that's going to be blue on my thing, all of these strike prices are now below the current price when you're in calls, so 586, we're trading, well, I don't know what this is showing us exactly, but 586 calls are in the money because, I haven't updated what's actually in the money over here. So 586 calls are in the money. And what do we mean by that is that the price of the stock is higher than the strike price that we purchased. When we're out of the money, that means the strike price is higher than the current stock's price. And at the money means you're right there. You're at it. You aren't in, you're technically out, but you're almost in. That's what at the money means. Okay, so again, gamma exposure. This is where you really make money. So we got these things right here. 40, we're going to say these 589s, 42 delta. Well, when you get this move and you end up a couple dollars in the money, and I know, $5 move on SPY, it's big. You're likely not holding that long, but your delta increases to 60. And so when you bought these contracts, every dollar that it moved, you were making 42 bucks. Now every dollar that it moves, you're making 60 bucks. You've basically 150%, or you have 50% more profit on the same amount of move as before. That is the power of options. It gives you more leverage at no additional cost to you. So you can see these out of the money people, somebody's trading way out of the money. They might see that they get 26 delta. So, sure, the contracts are cheaper. That's really the only reason people buy them. You need much larger moves to make the same dollar amount. These ones cost more the closer the money you are, but you get this shift sooner where you really start making money. Places where this really matters is end of day. where people are kind of taking those end of day lottos. Some people might have taken Nvidias or SPYs or whatever with me. You can, when you get into end of day, let's see, we don't really have a good example. When you get into end of day, you might have a contract that costs $7, but when your delta is $50, you know that if the stock moves $1, your $7 contract is gaining $50 in value, which, it doesn't guarantee you're going to make money. But if you do get that $1 move, that's a what? I don't know, 600% return on that cheap contract. And that happens because you've gone in the money. Gamma has shifted even, so you're even making more and more money. And so this is where the real power of options comes into play, that delta gamma correlation. So does everybody get it? 50 pack. Good question. Does in the money cons decay less? No. Extremely common misconception. People scream it from the top of the mountains, and it's just wrong, unfortunately. And so why do I say that? Because, and so this isn't an options Greeks lecture or options contracts lecture, so I'm not going to get into a ton of detail. So options contracts have something that is known as intrinsic value. You get intrinsic value when you are in the money because that thing's actually worth something. If somebody were to buy that contract from you, like if I buy these 586s, I can actually buy SPY for, whatever it is, 86 cents less than market price. Nobody's going to do that on SPY, but you can buy them at market price. Well, here is the issue. When you're in the money, technically speaking, every 1 penny that you're in the money gives you $1 of intrinsic value. And that's because an option contract technically represents 100 shares. So for every 1 penny, you make $1. Whereas, if you have 100 shares, for every 1 penny, you make $1. That's what they represent, So when you end up in the money, people say, oh, yeah, I'm in the money, no more time decay. Well, that's wrong because you might have an in the money contract and, beginning of the day, that thing might be worth $200. Well, by the end of the day, if it ends up 5 cents in the money, then your contract's worth $5. So theta, and we're going to get into theta too. That's what's doing it, Theta kills all contracts until you are deep enough in the money to offset the price of the option contract. Oh yeah, theta is killing them. You will only $1 per 1 penny, So if you got one of these, it's $1,000. You only end up $4 in the money. You're losing $600. That it's, so yes, time decay affects in the money contracts heavily, technically speaking. Okay, delta and gamma. Yep, delta and gamma delta is affected by the stock price because that's what moves the option contract. And then gamma is what controls how much delta moves based on the stock price. And yep, and they are completely based on the movement. An option contract, and again, I only put this disclaimer out there, don't dive into this. It's not worth studying. But, an option contract, its price only is moved by the stock. An option price will not move the stock. Again, there's times and places where it can have an effect on the market, but technically speaking, it is still not affecting it. Okay, so that's delta and gamma. Everybody got it? Any questions? Nope. Okay. So next one that we're going to talk about, theta. And what is theta? Theta is time decay. So we're going to keep this one super simple, super cut and dry. Theta tells you every 24 hours, how much will your option contract lose in value? If the price stayed completely flat, it did absolutely nothing, didn't even move 1 penny, then from, point A to point B, you are going to lose this much value on your contract in 24 hours. That's what theta tells you. So like I said, we're going to pull up something that's not SPY. Like I said, because something, this is a much better example. Because we had kind of weird prices. So I'm going to pull up Apple right here. We have theta. And these Greeks are technically from the close on whatever day that was. Wednesday, because we're closed today. So these are from the close price on Wednesday. So, and we're closed Thursday. And so this is telling us by close on Friday, this contract will lose $154. And the total value of the contract, basically when you hit the mid, is $154. And why is that? Because if it closes on Friday, right where we are now, it's out of the money. So it will lose all of its value. Well, up here, we can see this next one. Theta on this is 111 bucks, but the contract value is $340. So if it closed, if this ends up closing exactly where it is, this price is going to continue to drop. Theta is going to continue to increase. And this contract right here, if it closed exactly where it is, would be right around that $242 because it's a 240 call. So you would get $242 remaining in here. So you're going to lose 130 or so to value. And so that's what Theta is telling you. By 24 hours from now, how much will it be worth? And so obviously when 24 hours away is expiration, it will be worth zero, if not in the money. So Theta is a hard one, matters much less on scalps, matters a little bit more on day trades, and matters a little bit more on that for swings. And so everybody get that? Theta, you're just fighting against it. It's time decay. You lose value just for owning it. Everybody get that one? Pretty simple. Okay, no questions, so we're good. So final one we're going to talk about, Vega. You, how is it determined? Well, really, really, really advanced math to be technical, but also, so just to show you, and we're going to cover this a little bit later, you can see longer to expiration, much less theta. This one costs you 700 bucks, but you're only going to lose 12 bucks over the 24 hours. Closer you get to expiration, exponential increase in theta until once you get to expiration, theta is 100% of value as long as out of the money. But as far as how it's determined, you go look up that Greek math. It's not for me. It's advanced math. I just take advantage of they do the math for me, you know. But just know theta is increasing always the closer you're getting to expiration. Okay, so final one we're going to talk about, Vega and implied volatility. So these two go hand in hand. Vega tells you for every percent change in implied volatility, how much money are you going to lose? So obviously intraday, unless you're playing some crazy news spikes or whatever, or how much are you going to lose or make? Because, you know, if IV goes up, Vega adds value. If IV goes down, Vega removes value. So, you know, unless you're playing intraday news volatility, it's not going to be a huge deal for you. Where this matters, and the only reason I bring this up and teach about it, is earnings. When you see things like this that say 800% IV and you know that it should be 60%, and these contracts cost, you know, whatever it is, $1,000, and you know that you're about to lose, you know, 800% IV, that means your contract is going to lose whatever the percentage change is times Vega. That is what IV crush is. That's how when people say, hey, what will my option contracts be worth after, you know, earnings? This is the math I go do. I go figure out the Vega. I go figure out my estimate of how much implied volatility it'll lose. I use the theta to remove any additional value that needs removed. And then I use the delta to just, and you know, you won't be exact because you'll have delta, gamma, and it's always a big move on earnings, but you just multiply the delta times the move, you know? So, you know, people get destroyed by earnings because they don't understand how Greeks work and them working against them. So again, that's implied volatility, not huge intraday for us ever. Because, you know, unless you're playing news, there's typically not giant swings in IV intraday. They might be little, you know. You might get that tiny IV shift if you're like in calls and it's going up and you sell the top. It'll be worth a little bit more there thanks to a couple of percent of IV, but that's it, you know. But it's really not something you need to put much focus in as far as actually studying it. So that's the end of the Greeks. Took a little longer than I wanted. Does everybody have very basic understanding? Delta tells us how much we'll make or lose. Theta tells us how much we make or how much we lose just by holding it. That's the gist of it. Is everybody, we on the same page there? Okay, great. So final two things we're going to talk about here on the option chain, and then we are getting into actual contract selection and why we choose those contracts for the different types of trades. So final two things that I have on here, volume and open interest. What are they? What do they represent? So open interest only updated once a day. It is updated at market open. And what open interest is telling us is how many of these calls did somebody have on Wednesday that they still have open on Friday. So what this is telling us, and well, and the number is going to update, but on Wednesday, what this was telling us was there was 4,700 contracts of 242.5 weekly Apple calls open going into Wednesday morning. And then there's 40,000 traded apparently on Wednesday. So that's the next one. Volume. Volume tells us how many have been traded intraday. How does this help us? Well, the higher the open interest and the higher the volume, the tighter the spread, the tighter the bid ask spread. So you can see this is $10 apart. That's a nice little, anybody market ordering in and getting in there at 159 is going to hate it when you fill, below the bid or below the mid around 150, 151. You're already up 5% and they're down 5%, or 2%, whatever it is, so you are already making money on playing with the spread. And that's the main things they're going to show you. As far as warnings, if somebody's ever like alerting contracts or anything that are low open interest, just don't buy them. They're hard to sell. They're hard to fill. It's a pump and dumper special to buy those things and then sell them, because when you buy, there's a very good chance that, that bid ask spread might move up to the ask side. So if somebody fills at the bid and then they alert contracts at they fill at the bid, then they alert contracts, then a bunch of people buy them, volume goes up, spread tightens, they can sell that 5% pop from, the bid to the ask. So always be very, very skeptical. And for the most part, just stay out of those low OI contracts. They're dangerous. You don't want anything to do with them. So that's it for the option chain. If you ever hear us talking about the option chain, so yeah, we're gonna get into what are we picking for swings here pretty quick. And some things that I look for, things that I like to do. So we're gonna start small time frame, things to consider. What do we, what are some trades that I would look for? And we're, of course, today we're going to focus on I wonder if the QQQ chain looks any better. We'll use it instead. If it does, it looks horrible too. IWM, does it look any better? Just terrible spreads on these things. Okay, we're gonna go IWM because that one's actually the tightest spread that I've seen. As far as does it matter? Are these actually trade plans? Anything like that? No. This is merely discussion of contract selection if we would have taken these trades off of these levels. So, like I said, when I'm trading, I like to look at the option chain because I want to know how much can I make or lose on this trade. So for this example, we're going to look at IWM and say we're going to buy this. We've broken above 220. We've now rejected this level up here. We're buying the dip at 220. So we want to start looking as we're coming down, we want to be looking for calls on the way down into this support. So what do? We pull up our option chain. And now we start to analyze these contracts and say, where is the risk reward the best? And again, you don't need to sit down and do to the cent math. I do all this in my head and I'm horrible at math. So people can definitely figure out, the math quicker and better than I can. But we're just going to, look at this chart. We're going to say we want calls. We know calls are coming down. So we're going to look for a scalp. We want to bounce up. We aren't looking for a big move or anything. But we want to buy some calls at, basically this 220 level. And we want to look for a move up into some of these EMAs. We aren't looking for much, but we're just looking for a nice little bounce. And we know that this is a relatively small move. We're going to say we're looking for it up to here. So it's a 60-cent move upside. So now we know we can look at our delta and say, okay, we got on this at the money contract, we got $48 worth of delta and it's moving 60 cents. So I know that I'm getting about 60% of the value of one delta. Quick math in my head, I'm going to call it $30, So if I catch this little move up, I'm making $30. Now, if we have to look at the downside, And we're doing all of this while the market's selling. We're getting prepared to buy calls. We want to buy some calls here, and we're going to say it's right at 220 just for ease, 60 cents up. Well, we know that our stop, here's 220 where we're entering. We know that our stop is a new low. So it's basically 25 cents, 30 cents below us. So again, we go back to our option chain and we see 48 bucks, and we know that we're risking, like we said, about 25 cents. So we're risking $12 of this. We're risking $12 on this contract to make $30 on the other end of it. I now know that from, I know this on the way down. I know what we're going to be risking and what we're going to be potentially making right here. So I know that I like that risk reward, even just for a nice little scalp. And we know that we're looking for a small move. So on a scalp, for me personally, I'm not so much concerned with what the exact delta number is. I'm more concerned with planning for the size of my trade. So I'm looking for a 60-cent pop. I need high delta. If this thing pops and I make my 30 bucks or whatever it is, great. I make a nice little, what is that? 15%, give or take. I make a nice little 15% on this scalp. If it drops below, I lose 12 bucks. So I know that I'm losing what, 3 or 4%, something like that. No, 5% at most. I like that risk reward. So if we start looking at some of these further out the money contracts where people are like, oh, they're cheaper. And yes, and something that you always notice on an out of the money contract, percent return will be higher, but that also means percent loss will be higher. So we might only get our little, 15% scalp here, but we had a nice safe trade. We know if we lost it, we were risking about 5% on those contracts. If we go to some of these out of the money contracts where all of a sudden, if we pull back this 25 cents and we're going to lose whatever that is, $8 off of an $80 contract, then we're losing 10%. You're doubling your risk right there. That is why, these at the money contracts are a little bit more expensive, but you are risking more money by trading out of the money, especially on a scalp. Not to mention, on this upside move, you get your 60-cent upside move, you're going to be making a smaller dollar amount. So that's going to be the main difference between the at the monies and the out of the monies is larger dollar amount, smaller percent on the more expensive contract. Smaller dollar amount, larger percent on the out of the money contract. The main issue with those two is at the money, technically speaking, a much safer trade. You pay more money for the safety. The out of the money, much less safe trade. So when I scalp, I will always be within 1 or 2 contracts. If we're trading right at 220, I'll probably go for those 221s, just, because then I can, pay a little bit less, still have a high enough delta, still have a small move, pay me pretty good. I'm never going to be the person in those $4 or $5, $6 out of the money contracts, total lottos, those things happen on occasion. But for scalps, I'm always right at the money. Does everybody understand why? Any questions there? Do I think it's a good idea to buy already in the money contracts? No. We're going to touch on that for just a second here in a few minutes, but no, I don't. But does everybody get how we're picking up for scalps? Simple. Basically go, right at the money, as close as you can, is almost always going to be the best decision. So everybody gets that? Okay, so that's scalps. Next one is day trades. Day trades I treat slightly different, and you're going to notice we aren't getting too much into trade planning tonight, but you're going to notice, a slight variation here, but a similarity to how we choose a swing trade. Well, maybe I'm looking for a bit more of a move. Maybe I'm finally looking for IWM to kind of break this downtrend. We're seeing it break a downtrend. So we're buying the dip on it. We already know we're buying the dip, but I'm not in it for a scalp. I think that the market actually is finding some strength, and it has a pretty good shot at moving up. So I started to say, I want a day trade. Well, on those scalps, especially for things, your SPYs, your QQQs, your IWMs, a lot of the time on a scalp, you want to be trading the same day because you'll get the nicest move for the less money. If as long as you're planning your trade, your risk is fine. If you're looking for a day trade, you can of course trade a same day, but you need to understand you're dramatically increasing your risk by doing that. So generally what I recommend is just going to a next day expiration. We're going, and this is for day trades. And, obviously if you're trading your Apples, Amazons, whatever it might be, those are going to be weeklies. They're going to be Friday expiration no matter what. But maybe I'm looking for a day trade on IWM. So you want to be able to hold it a little bit. You don't want to be fighting the theta that's going to have it at zero by the end of the day. So you start to look at that next day expiration. And so we're just going to keep this chain up. We're going to call these next day expirations because they were at the time. But how do I do my contract selection here? Well, this time I'm a little less specific about being, you know, right at the money to really capitalize on a smaller gain. This time I'm personally much more concerned with um, wanting to make sure that my strike is within the move that I expect. And so what do I mean by that? If I'm trading IWM, I'm looking to buy the dip here, and we're just going to use my levels. First target is 221.24. Next target is 222.65. And that's my final target. What that means to me is I will not go above this strike, the next closest strike up. I want my move to be within the strike price that I buy. And so this one's, our target is 222.65. Can you go for the 223? Yes. But for me, as I was teaching earlier, you want to take advantage of that out of the money to in the money move if you can. So if we're buying down here at 220, for a day trade, I'm really likely not going outside of a 222 strike because I want to be able to capitalize at least part of that move in the money. Because, this move from 222 to 222.65 when you're in the money is going to pay you more than the dollar move you get from 221 to 222. That smaller move will pay you more. So I'm likely not going to be in a 223, but I always want to be within my range. So again, you can look at any stock that you want. Doesn't matter. SPY. We're buying dips down here. If I'm targeting this 589, I'm not trading 590s. I'm not trading 591s. I'm trading 589 for my day trade. Again, if you're all right with some risk, you can do same days. If you want a little less risk, go for those next days. But always stay within the move that you are expecting. So if you want to go 586.27 up to 589, you don't go above a 589 strike. And that's how I treat all day trades. I become slightly less concerned with Greeks when I'm looking for a day trade, but I want to make sure that I still have a reasonable amount of delta working in my favor. I don't really like to give numbers or, like, oh, never take, like I said, saying never take a trade with 15 delta. Like, I don't like to limit that. There's times and there's places for it. Maybe you're trading a $1,000 stock that moves a bunch and $15 delta is plenty. But generally for a day trade, I do like to be above that 25, 30, if I can, so that I know I'm really getting maximum gamma as I get closer and closer to in the money. But for a day trade, the main rule that I like to follow is just to strike within the move that I expect. And that's on everything. That's, not only on SPY, that's even on Tesla. I mean, if you're trading Tesla and you think it's going to 395, if you can't afford a 395 or less, then you're gambling and you shouldn't, it's the risk reward's not in that trade. If you're looking for 395, don't be in a 410. Don't be in a 420. I know they're cheaper, but they're cheaper for a reason. If you can't afford a good contract, then you don't take the trade is a rule that I follow pretty heavy. So that's with everything. Keep your strike price within what you like. And then on the other side of it, if you're in a 395 and you're in it from way down here off 390, like you probably should have been, and you're in that 395, well, awesome. Because when you hit 396 and 397, 398, and it keeps going, you are making money hand over fist being in the money right there. So, always keep it within your range. And if you get the breakout, great. If not, then no big deal. You still capitalized on the move that you wanted, and your contract having that higher delta and being closer to the money pays you more. So everybody get that on day trades. Again, pretty simple rules. Okay, we're good. So, final one we're going to talk, or final thing we're going to talk, swing trading. So, and we're gonna keep using Apple because I like the Apple chart right now. I may or may not be in an Apple swing right now, hoping that we get some upside movement, but we'll see. Not looking good so far, but we'll see. So Apple obviously sells down to this major support, big major breakout area with the retest with the nice rip. Plenty of reason to be looking to be buying the dip here on Apple. And and so I'm in the swing trade. And when I was picking my contracts, going into that end of day on Friday, chop zone, I was buying my dip right down here, right where I wanted to. Well, then I go to my daily chart and I start looking at this, and my upside target is 245. I'm not saying that Apple is putting in a reversal or anything like that, but I know that that is my upside target, the maximum target that I'm looking for right now. Can it reverse and keep going more? Sure. Can it break down and keep going? Sure. But to me, I look at this and the risk reward is for longs here. We are strong support. Market bought back over it, held it into the close. No questions asked. We're swinging long on this type of thing because the risk reward for shorts is horrible. If you short this, your stop is $5 above you, looking for maybe $6, $7 move down, $5 move down. I mean, not looking for much move down. Your risk is higher than your reward. Well, up here, if we long, our stop is below ideal world, 241, 240, looking for 245. $2 risk for $5 upside, no brainer. So when I'm swing trading, I almost always buy my target. So could you have bought the 240, 250s and been really happy if we happen to push all the way up to that 245? Absolutely. But when I'm swing trading, I will buy my target. And you guys know I trade with very realistic targets. I know there's going to be somebody out there that says, well, I think Tesla's going to 450, so I bought a 450, and River said that's right. That's not right. You want reasonable strikes always. If your target is $50 out of the money, or $50 away, redo your plan and start living in the real world, have realistic targets. And so that's what I personally do on my swing trades. Barring a really far away target, I'm buying the target price. Are you just as safe buying the 245 or 240, 250 because Apple skips strikes or whatever? Absolutely. But I bought that 245 because that is my final target. Again, if we get the break above, awesome. I mean, I won't be in there anymore. Obviously, everybody knows I sell fast. But the 245 is the target, so that's the strike that I buy. So again, for me, just to kind of really quick rundown on it, scalps, I'm never more than $1 out of the money. I mean, I want maximum return on smallest move is always, always, always what I'm going to be looking for. The For day trades, again, typically going to be looking at, at least 1 day to expiration. Really, analyze your risk reward with all trades. Start looking at that delta, start looking at the theta, especially on a day trade. If you're fighting theta, you have to take it into account, a little less on a scalp because they typically happen fast. So theta is not a huge issue. But, keep those strikes very reasonable. Typically on a day trade, I like to go about halfway between target and entry price is going to be my preferred strike if I can get it. And then for swing trades, again, a lot of time I'm going to buy target price. This is, like I said, these are, swing trades can be a tricky one because, like I get on Tesla the buying and on a swing trade, generally speaking, and of course this is depending on the plan. Like everybody, everybody in my classes knows that I was short XLE back in end of November. Got short on XLE. Of course, sold it way too early. Those contracts I bought middle of next summer because I was playing on a fundamental theory, not so much a technical theory. So I bought a bunch of time on that. Generally, on a swing trade, I still want to be right or wrong quickly. But I'm almost always going to go for the following week. I want to buy the following week expiration, just so I'm fighting a little less theta. I can let it work for a couple of days if I need to, you know. So that's really the only difference for swing trades. Of course, if you have a longer term swing trade, maybe you know you aren't taking the best entry, maybe you're early, add a week's time. If you're ever buying and you think you're early, add some time. I mean, really just don't enter, you know. If you don't have the best entry you can, you're gonna have a hard time making money, you know. But so does everybody get that? I know it's kind of a lot. I know it's a lot to think about. Does everybody get what we're saying about, I tried to keep the Greeks simple. Delta tells you how much you're going to make or lose. Scalps stick to right at the money is most of the time going to be the best idea. Day trades, generally trade the next day or, Friday's weekly contracts, and shoot for about halfway between your entry and your target. Swings, you're just fine going out to target. Obviously, some of those more expensive ones, you can even go a little bit further out if you need to. But always make sure that you're keeping it reasonable. That's the biggest thing that I want to teach here tonight. And so, any other questions? I'm going to go up a little bit, see if I missed anything. Any other questions? We got, 5 or 10 minutes left. Let's get to them. Yep, all previous lectures are recorded, pinned in tabs. They're all over the place. Do I think, and so to go back to this, do I think it's a good idea to buy already in the money contracts? 99% of the time, no. And the reason for that is the risk is high. You have 56 delta, these things move really, really volatile. So you want to be, a lot of the time, the potential higher reward isn't there. Like I would rather spend 60 bucks less, get this pop, only make a few dollars less and still wind up at that delta. That's for me how I would like to trade. Now, I am happy you brought this up because this goes back to that thing I said at the very beginning, talking about flow. One of the very common things that you'll see people talk about, why did this person buy these? I saw somebody buy $30 million of in the money SPY calls or whatever it is. And the reason that they do that most of the time, and we'll use SPY and we'll use a random date. Let's see. And we'll go for, I don't know. Yeah, middle of March. Why not? So what you're gonna see, and the main thing that you're gonna see here, and obviously there's not a lot of people trading these. So side note on Delta, again, not getting too specific to it. One of the things that Delta is telling you is the percentage chance that these contracts will end up in the money. So when you have a 95 Delta, that's also the market telling you that there's a 95% chance that this contract will end up in the money. Well, if you look at SPY, and you start thinking about its price. So you look at this contract, these in the money 365 calls on SPY. Again, we're just using something random. They cost $23,000. And so you're like, whoa, that is insane. Well, you have to think, like we talked earlier, every $1 you're in the money, you have $100 in value. So when you're $2 in the money, or $200 rather in the money, and they're even more than that, 200, 30 bucks, 20 bucks, whatever it is, in the money, you obviously have your intrinsic value of $22,000. Well, where does the benefit in this come? So this is also giving you the exposure of 95 shares of SPY, and it costs, we'll call it $27,000. Well, if you wanted to turn around and you wanted to go buy 100 shares of SPY at the current price, you're going to spend $58,949. So you're saving 20 grand by doing this. So that's what big money is doing when they do those kinds of things. It's really just a really safe trade. And more often than not, it's just a way to get some nice leverage at a discount. Maybe they don't want to go out and buy 100 shares of SPY, but they want some exposure to SPY. Well, the chance of SPY dropping to $360 is, well, this prices it in at 5%. It's way less than 5%. The chance that SPY as at 360 by March is like zero. That's so the safety's there. And the math is really easy to calculate. For every $1 that SPYs moves, you're basically losing or making $100. And that's not changing. So the only way that these things can go to zero is if SPY drops to 360 from 365. So we need a 200 and I don't know, $29 drop for these on SPY in the next 2 months for these to go to zero. So that's when you see those big on the in the money orders. That's what it is. It's just big money taking a safe bet. One that everybody talks about is Nancy Pelosi. Really bad trade, but she bought 50 contracts. That's it. Like, and look at every single one of these has, I guess not quite everyone, but all of these in the money ones have more than 50 contracts. She bought 50 contracts of $300 in the money. Like, a lot of people forget that Nancy Pelosi actually chased Nvidia once it was already up 400% on the year. And then she bought $300 in the money contracts. So rather than buying shares, and I think it wasn't a very good trade because she was so deep in the money, there wasn't much leverage. But that's all she did. She just used a leverage way to get into shares. And that was it. It was just a very safe trade. It was no insider trading. It was none of that. It was, Nvidia is up 400% and very obviously changing the world. And the CHIPS Act is a couple months out or a month out. Be long on chips. It was sort of just a no-brainer trade that her and her husband decided to take. And so they went deep in the money. They got 95 delta and they got to pay because they were so deep in the money, they basically got like a 2% discount on shares. So that's it. Okay, so any questions? Again, 5 minutes left. Are we in the early stage of a 10% correction? Who knows? I mean, some of these things got to be like almost down 10%. I mean, the only thing that I've been pointing out to people is that so for the very first time, the market is setting lower highs and sustaining those lower highs. You also always have to look at the downside. We're holding exactly where we need to be holding to remain bullish. Nothing technical has changed, very, very big picture, but I'm not going to be entirely surprised to at least see us go fill this elections gap. The market is making it very, very apparent that we have fears coming over the next 4 years that we have not had for the last 2 years. This is a market that has a market like this is one that has very little fears, very little questions, a very expected path from the Fed, from the president, all of that. Obviously markets pull back. This was the unwind trade, the carry trade unwinding, so that was an aggressive one, but this is a market that's happy and a market that has answers and a market that has very little uncertainty. Well, this is a market that has uncertainty and fears and worries. And will they be founded? Who knows? But when you start seeing moves like this on the 10-year, you start seeing moves like this on the those bonds, the market is feeling on edge that a recession became realer than it was 3 months ago. So is the market going to pull down 10%? Maybe. For right now, you have to remain bullish, you have to remain buying dips, and you have to watch this 584 level. If we break 584, we're filling the election gap to that 576. I'm not saying in a day, but we're definitely filling it. If we really get a strong close below there, we're going for it. And then if we really start to break down, we start to lose this 570 level, then we're looking for some downside. Am I going to say we're going to make it all the way down here to 540 for that full 10% correction? I guess it'd probably be like 550 from 610. Who knows? I'm not, it's a guess. But we break below there, I would start to look for these lows down here at 568, then maybe 565. But I'm not looking for a full 10% dumper or nothing like that myself. Well, we have a lecture on how to find levels and or targets. Yep, I already did support and resistance here a few weeks ago. And then we'll really get into using that stuff when we do building a trade plan here in about 2 weeks, I think I said. Okay, so any other questions? Thank you all so much for being here. We had a nice little crowd. I see a few people getting out of here. Thank you. Thanks for showing up on the close day. It's really nice to have you all. Thanks for the support and asking for it. I always appreciate all of you. See a lot of the same names here all the time. So thank you all so much. Yep, right on, everybody. Thank you all very much. If we got no more questions, we'll call it here. Of course, if you ever have any questions, feel free to shoot me a message. I always try to respond to my DMs. If I don't respond, I missed it. Just send another one. Yeah, thank you so much, everybody. Have a great night, and I'll be trading tomorrow. I think I open Friday. I think I do Friday open in premium voice chat. So I'll catch all of you tomorrow, closing pro, and everybody have a great night. Thank you all so much. We'll talk to you soon. Thank you.